Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone. Ira Epstein for Tuesday, on August 9th, 2011. And yeah, I intentionally waited for the Fed announcement and the reactions today because what I would tell people is watch my hands. Put your hands in your pocket. You don't trade on a day like today. I have a trading course. It's called the Charting Course, by the way. And it's really more about charting than it is about trading, but if you learn how to chart, trading goes right with that. And one of the things that I teach, one of the main rules, is you don't go into a major report unless you have to. And you didn't have to. And a major report is this Fed report, especially after the downgrading we just had from Standard & Poor's and what's been going on in Europe. How I read what the Fed did in plain English is they're going to debase the dollar even further. I think the dollar is going down a lot more from this level over time. Why? The Fed said that they're going to keep interest rates low, exceptionally low from what I understand, into 2013. They keep moving the timeline back. They're going to flatline the yield curve, and that's why you saw the bond market at one point today get up to 139.27. Yes, it settled back because a lot of that was short covering, but unbelievable. The gold market's going to finish the day out today around the 1743 level, and you'll say, God, is he a magician? How does he know that at this time? Because they close gold, according to New York time, Eastern time, at 1:30. That's where the official settlement will come in, so that's where it's at. For the gold market, I am as bullish as I was before, except I'm ramping it up. But I would like to see a break, and you'll say, why am I ramping it up? Because the lower dollar will create, even in my opinion, a stronger value for the gold market. The silver market is responding to weak economies. The Fed told you that, but it probably is getting itself overdone considering copper was able to rally 8 cents today. And I want you to look. Copper came from the 381 level up to 405 nearly. So let's take a look at this gold chart and understand what you're dealing with. You're dealing with what we call in the trade a parabolic rise in the market. And this part of it, these past 2 days, and I'll blow up the chart, the past 2 days were due in large part to the sovereign debt issues that took place in Europe on Sunday and Friday's surprise downgrading of American debt by Standard & Poor's. Okay, so you give the market the benefit of that. In addition, one of the things I've been writing about is that I think you look at the end of July's settlement, 16.25, and in bullish years I look for the market to finish higher than that by the end of December. I could be wrong, but I'm telling you what I'm looking for. Next, I start looking at chart patterns. Now, this is the same chart without the swing line study. You can get the swing line study in my charting software. It's a small subscription fee each month, and it works on stock charts, it works on options. Yes, we can chart options in our charting software, futures markets, ETFs, it does that. And it gives you an idea of what the market's about. A bull trend is where you're making higher highs than previous highs, and you have higher break lows. Okay, so we see that part. Next, I start looking at the 18-day average of closes, and I refer to it as the line in the sand. I won't change my thinking, and I get a lot of emails about this and people writing me, and I tell them the whole concept of the 18-day average, as I interpret it, is when the market is over it, you're looking for potential buy signals. Period. Got it? It's that simple. This can also, on phase 2, become support if it's above a previous break low. Well, it's not quite there yet, but my guess is it'll be there tomorrow or the day after at the minimum. I next look at how the longer-term moving averages are going. Now, if you've been watching CNBC, Bloomberg, Fox Business News, what have you heard? The one thing I promise you've been hearing is they're talking the 200-day moving averages in the stock market. If not, go back and listen to what some are talking. What they're really saying is they're looking for reference points. Why is the 100-day any less important than the 200? Is the 200 more important than the 400? I can go on and on. There are multiples of days in a year. There's really 222 business days, right? But they picked the 200-day number, and somebody did it a long time ago. And part of the concept of moving averages is following the herd. Using that theory, the one thing I look at all the time, it's not one, it's one of the things, I said that wrong, is where the market is in relation to a Bollinger Band. The Bollinger Band is an algorithm, a fancy word for a math formula in which you're looking at two standard deviations from a mathematical mean, an average if you will, to determine a 95% reliability. Or probability might be the better word than reliability. In fact, I'll make it that word. And the probability is that the market will stay within the black bands 95% of the time, which also means by definition, it can pop out to the top side or the downside, depending if you're in an uptrend or downtrend, 2.5% of the time. The more consecutive days you stay over it, the faller that probability goes. And in the stock indices, I was trying to compute some of it, I was down to less than 0.5%. That it would be able to stay under it before a pop happened. That doesn't mean you buy. It can go there. You can go to 0.25%. You don't fade a trend. The name of the game is to know that in the gold market, you're starting to extend an awful lot. This could be a danger zone. That's exactly what I'm saying. The slow stochastic study is close to losing its embedded status. Whoa! You got an 80.71 reading. When the market reopens, it's liable to go under it. If it does, it would not surprise me to see the market try to slip back and find support somewhere in this area of the chart. Now, you'll say it's just going to keep running, and you may be right. Remember, I'm the guy that's saying that I think the dollar is being debased. I think that's what the effect of the Fed action was today. I think that's what they're after. And the question is, as long as we don't go into a deflation period with a cheaper dollar, certain markets attract value. And normally, all I can say is normally, not statistically, a falling dollar is favorable to the gold market. They're an inversion type market. Not every day, not every month, but that's the norm of it. So I'm favorable to gold in the long term. The silver is a whole different world. Silver is still an industrial metal until the psychology of silver says gold has run up so much that this is a good play, and that's how you got to the $50 mark recently. Now the gold today broke away from the silver. Silver went down $1.68 and gold's up another $30 roughly. Big move. But the silver is getting oversold. And look where the silver's trying to hold on. Near the Bollinger Band bottom. And it might be there on the close because, again, like the gold market, they'll close it as to where the market was at that point in time. The copper had such a wild day, I can't get it all on the chart. But if you look at the Bollinger Band, 404.85, look where the market finished. Literally, it's going to be against that number. I don't know if it'll be under it or over it. I don't look at the final close yet. But that's all that I had to see. Am I bullish on the copper and the silver right here? No, these are bear market rallies still. The gold is the market that I think is favorable, but certainly not at the current price level. What about the crude? Well, the reason you're seeing the crude rally late in the day, you had 5 days in a row coming into today under the Bollinger Band. That's how you looked. You had your embedded stochastic. What are the odds of going into a 6th day? Extremely, extremely low. I just learned in the stock index, I saw it yesterday, that the Dow had done it, I believe. Okay, but the odds of staying there are very slim. So you started getting your rally back. You didn't finish it. That's yesterday, and look where you're at. You're fighting against now the Bollinger Band. You're probably going to be under it today, but you'll probably pop tomorrow. Okay, there's nothing magic about 5 days. And what have I always said on these tapes? And the word is always. I say that getting under this band doesn't mean it's a buy. It's one thing to cover a short. It is a very different thing to be buying a market long under the 18-day average of closes and to be buying just because you're under a Bollinger Band. If you're going to do that, and I've got to show you this, why not buy it here? Well, then I guess you're buying more there. Then you're buying more there. You're wiped out at some point because you can't handle the financial pressure. That's very typical. The gold-silver ratio exploded out the other way today in favor of gold, not silver. And this was a move back over the Bollinger Band. So until you get back under the 40 level, right in through there, the market's favoring gold, not silver. Doesn't mean you can't get pullbacks, but the favorite is the gold market over the silver right now. And until you have a reason to change your opinion on that, sorry for you silver diehards, but that's how I'm reading it. The bond market, another dramatic move up. I'll be watching when the stochastic eventually turns down. But we're talking 2% 30-year yields, I guess? Whoa! And, you know, that was intraday. I'm not sure where the market finished. I didn't get the cash at the end of the day. Here's the Rebob gasoline. The pop-up over the Bollinger Band, something you should be expecting. So I want to remind you, I cover what you're hearing me do right now through our futures trading kit. It is free. It is a download that we send you with certain passwords. Those passwords will enable you to activate the charting software, and then you'll get another series to hear my recorded webinars. I call these videos. The webinars are when I put out specific recommendations, give a lot more detail on what I'm doing, and of course I do put out buy and sell recommendations in my oral and written updates. How do you get it? Well, if you haven't tried it before, it's totally free. If you watch these videos, you'll see my different offerings, and I will be writing a metal report, a gold report this week. I'll have it ready either Thursday or Friday for everybody. Have a good day. I'm Ira Epstein.